All right, in the world of investing, two heavyweights are always battling for the top spot, the ETF and the mutual fund. Today, we're ringside for the main event, breaking down how they stack up, blow for blow, to help you pick the right champion for your financial goals. So, let's get ready to rumble. So, who takes the belt? That is the big question we're tackling. But here's the real secret. There isn't one single winner for everybody. The champion for your portfolio? Well, that depends entirely on your strategy, your goals, and even the type of account you're investing in. Okay, so before that first bell rings, let's meet our contenders. Now, at their core, they're both designed to do the exact same thing. They pool investor money to buy a big, diverse basket of things like stocks and bonds. But while their goal is the same, believe me, their fighting styles in the ring are worlds apart. In this corner, we've got the agile and super fast-moving challenger, the Exchange-Traded Fund, or ETF for short. Just like the name says, it trades on an exchange. That means you can buy or sell it just like a share of Apple or Amazon, anytime the market is open. This gives it this incredible flexibility, and that's its key move in this matchup. And in the other corner, we have the seasoned, powerful champion, the mutual fund. This contender has a more, let's say, deliberate and methodical style. It only prices and trades once a day, and that happens after the market closes. Everybody who bought or sold that day gets the exact same price. Its signature move? That's structured simplicity. Ding, ding. All right, round one is all about speed and timing. And this is where we see the most immediate and, honestly, the most dramatic difference in how these two operate in the heat of the moment. This comparison really lays out their different rhythms, doesn't it? The ETF is all about quick jabs and fancy footwork. It's trading constantly, all day long, with a price that's always moving. The mutual fund, on the other hand, it just lands one single decisive price point right at the end of the day. This speed gives ETF investors a ton of control. You can react to market news instantly. You know the exact price you're paying the very second you click buy. And you can use more sophisticated trading tools like limit orders. For anyone who's an active trader, this flexibility is a huge, huge advantage. All right, let's move on to round two, the costs. Because look, over a long investing career, even tiny little differences in fees can feel like a body blow to your returns. They just slowly drain your portfolio's stamina over time. Just look at this chart. There's a pretty clear trend here. ETFs, which usually just passively track an index like the S&P 500, tend to have really, really low annual fees. Now, mutual funds can be just as cheap if they also track an index. But those actively managed funds, the ones where a manager is trying to beat the market, they often come with much higher costs. Let's break that down a bit. That expense ratio, that's the yearly fee you pay. But some mutual funds can hit you with something called sales loads, which are basically commissions you pay just to get in or out. A real low blow. They also often have high minimum investments, like $1,000 or more. ETFs, on the other hand, let you get started with just enough money to buy a single share. And now for the main event, the tax fight. Seriously, for anyone investing outside of a retirement account like a 401k or an IRA, this round can be a technical knockout. The differences here are subtle, but the impact on your bottom line, it can be massive. And here it is. This is the headline. When you're investing in a standard brokerage account, the kind where you pay taxes on your gains, the way ETFs are built gives them this powerful, almost unfair advantage. Let's dig into how they do it. Okay, so this is the ETF's secret move. Let's walk through it. Say a big institutional investor wants to sell a huge chunk of their shares. Instead of the fund selling stocks for cash, the ETF provider does something called an in-kind exchange. They just hand over the actual underlying stocks. And here's the crucial part. They hand over the stocks that have gone up the most in value. This purges the biggest potential gains from the portfolio. And the result? No tax event for you, the person who's still invested. It's an incredibly slick, efficient system. Mutual funds just can't do that. When other people sell their shares, the fund manager has to sell stocks to raise the cash to pay them. And if those stocks have gone up in value, well, that creates a capital gain that gets passed on to all the fund's investors, even if you didn't sell a single share yourself. Think about that. You can get a tax bill for something you had no control over. It's a real sucker punch to your returns. The final bell has rung. We've seen the strengths, we've seen the weaknesses of both of our contenders. Now it's time for the judge's decision, which is your decision. So let's look at the scorecard to help you choose the right champion for your portfolio. This is basically your cheat sheet.
Are you a hands-on trader? Do you really care about tax efficiency in your brokerage account? Then the ETF column is probably calling your name. Or do you prefer to just set it and forget it with automatic monthly investments, say in your 401k? Well, then the mutual fund might be your go-to. Just match your style to the features.
But hold on, after all these rounds, what if the final verdict isn't a knockout? What if the smartest strategy isn't to declare a single winner at all, but to actually get both of these heavyweights fighting on your team? Now this is the professional approach. You use each fighter where they're strongest. So, in your retirement accounts, your 401k, your IRA, where taxes aren't an immediate issue, the easy, automatic investing of a low-cost mutual fund is just perfect. But in your taxable account, you deploy the super tax-efficient ETF to defend your returns from those capital gains. And that leaves us with one final thought. We came here looking for a battle, but we may have actually found a partnership. Perhaps the real victory doesn't come from picking one over the other, but from combining these two champions in your portfolio for the ultimate 1-2 punch.